$118,000 is the price line that could decide Bitcoin's next 60 days. Most traders aren't watching it, and even fewer understand why it matters. This isn't just about price, it's tied to ETF inflows, global liquidity trends, and key macroeconomic shifts shaping the market. In this video, you'll get the key price level most traders miss, the macro signals shaping Bitcoin's role as a survival asset, and an altcoin metric flashing early warning signs. If you're still waiting for alt season, you're already behind. What's happening now is something else entirely, and catching it early could change how you invest for the next 90 days. Let's break it down. First up, Anthony Pompliano explains what's happening to Bitcoin now is something very few are talking about.
Bitcoin has gone from a contrarian trade to consensus trade. In order to do that, you need it to become less volatile, because for institutions, what they want is they want something that is more volatile than the assets they hold, but they can't have something that is going up, hundreds of percent and down 90%, and they have to constantly report kind of a mark to market. And so what I think you're watching here is just the maturation of this asset. And then what I also think is pretty interesting is the holder base is rotating. And so you went from kind of a pure retail audience that, frankly is subject to fear and greed, to now you have a lot of institutions that in public companies, they're not going to sell. You have the ETFs, they're likely going to act very differently. And so I think that this is all kind of natural and a good sign for Bitcoin in the long run. I think that Bitcoin will definitely go to $1 million at some point in the future. I just think this cycle, right, it's very unlikely that it's going to go to $1 million. And so what is the floor? I don't know, right? What I do know is right now at $112,000, $113,000, it's pretty oversold. And so I would expect that you have two things lining up. You've got kind of the overselling of Bitcoin, and you're headed into kind of September, October, which is usually a pretty good time, especially if it is the year after a halving. But also, if you look at like the VIX seasonality chart, usually right about now, you'll start to see the VIX really start to kind of move upwards, and we get a lot more volatility. And so I just think that it's August. People are on vacation. They're tired. They're, not paying attention, and things kind of just draw down. And starting in September, we should see Bitcoin kind of come back alive again.
Because of what, though?
There is kind of a simple thing of just like people are in front of their screens in September. They're not in front of their screen in August. And so people are buying and being more active. But also, I think that you've got a lot of speculation on a Fed interest rate cut. I think you've got a lot of the people who raised capital for these Bitcoin treasury companies that are going to start buying in kind of late August, early September.
Pompliano says this cycle probably won't bring a $500,000 moonshot, but it's not setting up for an 85% crash either. Bitcoin is maturing fast. Institutions are leading the charge. Long-term holders now make up the majority. This means less panic, less volatility, more stability. And the chart is already hinting at where the real action might be. Buyers keep stepping in around the low 110Ks. That's not random. This range acted as a launchpad during last year's Q4 rally. Add in seasonality, October is historically one of Bitcoin's strongest months. Now layer in macro. The VIX is rising, Fed rate cut rumors are back, and companies that raised capital are starting to put BTC on their balance sheets. That's not hype, that's a setup. Watch 118K closely. That's where buyer volumes surged before the last stall. If Bitcoin flips it, that could become the new base. This isn't speculation, it's strategic positioning, and it's just getting started. Arthur Hayes is calling out the greatest illusion of our time, and he's not holding back. You're not just being priced out of life, you're being gaslit while it happens.
The money printing that's going on, and as somebody who is trained in a traditional Western business capitalistic framework, when you enter the space in 2008 and every single bank is getting a government bailout, and you're taught that that's kind of a bad thing, but actually it was a great thing for asset holders. And we kept our jobs, which we all probably should have been fired at all these institutions. And so, I entered the space sort of jaded already, and this is complete bullshit. And so when I read the white paper about Bitcoin, it sort of aligned with me philosophically back in 2013. I started trading it. I saw how immature the markets were. I saw that my value add was trading derivatives, and sort of started BitMEX, just trying to build up that space. And then as I got more into more of the, buying and holding, because, obviously I have a business that does trading and whatnot. My main thesis, and this is basically all that I write about, is money printing, right? And the different ways in which the authorities around the world try to hide it from people and try to gaslight you about why it's not happening, and trying to make it seem like it's okay that, a house costs 75% of your disposable income, and all these sorts of things all around the world. And so I think it's a global phenomenon. Unless you're extremely wealthy, you feel the effects of this inflation that every single government, regardless of whether they're, completely communist on one side or capitalist on the other, everybody does the same thing. We're all on this sort of fiat debasement boat together. And Bitcoin has been this shining light, which has been the best performing asset in human history since it launched in 2009. And so I think that this has been a great ride, and obviously it's still early, for people to get involved in this industry. I wouldn't say that just because you're coming in at 2025 and Bitcoin's at 120,000 or whatever it is that you've missed the boat. We still have a long way to go. And it's going to be very interesting to see what Powell comes out with, because everybody's saying the Fed should cut. You have Trump chirping on him. You have these shadow wannabe Fed governors. Some of them are on the board. Some of them are proposed nominees. And supposedly Powell is this Volcker 2.0 type figure who's supposed to inject some credibility back into the Fed of this, nonpartisan, which is bullshit, non-money printing organization. And so he's got this situation. And on one side, there's an argument saying, okay, there's a labor market. There's all these sort of statistics you can roll out saying this is why the Fed is being too restrictive. But on the other hand, and this is what not that I have a probability weighting between the two, you have human nature, right? And you basically have this person who's been vilified for good and bad reasons in the press by his ultimate boss, the president of supposedly an independent organization. Does he get up there on Friday and say, oh yeah, sure, I cave, we're going to cut 50 basis points on September, was it 17th or 18th? Like, as a human being, as a man, how does that feel to just be completely bitched out and then you have to capitulate on the biggest stage in the world? So I think there's a high probability that probably ultimately the Fed will cut at some point, whether it's Powell or whoever else replaces him or whatever, maybe Trump fires him, whatever it happens over the next year. But I think there's a high likelihood that Powell sticks it out and just says fuck you to Trump and doesn't cut, just because he's a human and human beings don't like to be put in these sort of situations. And I've been having this argument with a lot of very senior and prominent macro writers who, point all these reasons why Powell has to cut and, why his job is so, uncomfortable being sort of the foil at which Trump launches all these tirades against. But at the same time, what a better way to prove that you are an independent monetary actor than say, no, I'm sticking with my guns. I think that 4.25 to 4.5% Fed funds is neutral and fuck you, Trump. And because I'm Jerome Powell, I'm an independent head of the Fed.
He says the money printer is always on no matter who's in charge. Governments everywhere, whether capitalist or communist, are quietly debasing their currencies. And the scary part? Most people have no idea it's happening. Inflation isn't an accident, it's a policy. And unless you're already wealthy, you feel it every single day. Housing, food, life itself. Everything's getting priced out of reach. And this is where Hayes gets clear. He calls Bitcoin the off-ramp, not a hype coin, a survival tool. Over the past 10 years, Bitcoin has outperformed every major asset class equities. Real estate, gold. That's not opinion, that's fact. Even at 120K, Hayes believes we're still early. Because once the Fed cuts, and he says they will, the liquidity floodgates open again. Powell may deny it's political, but pressure is building. The labor market is softening, Trump's back in the headlines. And the next move could change everything. Hayes isn't calling a pump, he's calling out the system. Next, we have Gareth Soloway. He just broke down Bitcoin's latest chart move sand, why one level could decide if the rally stays alive or fades fast.
Bitcoin is on the move, a big surge following Jerome Powell's much more dovish tone than the market had feared. And basically what Jerome Powell said was that the labor market weakness does warrant rate cuts. So we saw the Fed watch tool going from 2 rate cuts expected to 2 rate cuts, but the odds of a September rate cut went up to 90% from 70%. And I think the market had been, over the last few days, we've seen Bitcoin trading down, we've seen the stock market trading down going into this. Investors were nervous he was going to come out and shut down rate cuts as even an option. And now he's basically saying, yes, it does warrant rate cuts because of labor market weakness. So let's know that. Now let's dive into the charts. Taking a look at Bitcoin, the day today, what a great move on Bitcoin, surging from a low of around 111,800 all the way up to 117,000. We know that we were coming into the key pivot low right here. Well, look at that. Low pivot, there's support. Now, having said that, we also have to understand that even this bounce is not making Bitcoin in the near term bullish, right? Now, why do I say that? Because essentially what we have here, and I'm going to change the color of this to orange so it really pops out, you have this upsloping trend from April, from the beginning of April 2025, that connects through the low in June of 2025 to this low here in August, and then we broke down. And so it's very common when you get a breakdown in any chart, doesn't matter if it's a stock, commodity, or crypto, that you go down to your first support and then you get the bounce, right? Buy the dippers, come in. The problem is, and this is what I'll be watching as a party that is monitoring the move on Bitcoin, is do we get rejected right here? Technically speaking, we closed below, we confirmed, this now becomes major resistance. So if you're someone who is long Bitcoin and cares about it in the near term, you need to see Bitcoin break back above the 118,000 level, close there and confirm. If that happens, you can then revisit your double top highs right here at 123,000 and change. All right, classic double top. I'm gonna actually flip that back to yellow just to note again, support level and resistance level up here. But really, this is the level you are watching as a near-term Bitcoin investor or trader. That is the point of contention that should be resistance, a retrace to the scene of the crime. Why is it called the scene of the crime? Because this is the trend line, or essentially the jail wall, right? So this is the prison wall, this trend line, and you can see we went to the wall, got rejected, went to the wall, got rejected, went to the wall, got rejected. The scene of the crime is where you break through that wall and now you retrace. Very common for charts to retrace. The difference is this was support here, and here. It is now going to be major resistance. And so again, it's not to say that Bitcoin can't get through this level. It can get through this level, but it should be resistance and probability, which is everything about technical analysis, is what is the most probable outcome, is that it should get rejected there. Okay, so again, now it doesn't mean it has to be rejected. Remember, probability in this case is about a 75% chance that it gets rejected there. That still leaves 25% that it pushes through and confirms above. That's fine. But if you're again looking for what is the probable level, the trading level, it's to short Bitcoin at the 118,000 level. So that's where we are at this point. Great bounce on Bitcoin. It's very close. We got to about 117,000. I could see over the weekend us knocking on this door of 118,000. And then that is where, whether you're a bull or a bear, you are watching closely, folks, because again, we have to see what happens in that scenario.
Bitcoin just surged from $111,800 to $117,000. The catalyst? Powell's dovish tone lifted expectations for rate cuts. September odds jumped to 90%. Now, the chart. We've seen a breakdown under the April trend line that once connected the lows of June and August. That line flipped from key support to stiff resistance. Bitcoin bounced, but it didn't clear that wall. For now, 118K is the pivot. If BTC closes above it, it could retest the double top highs near 123K, but the odds favor rejection roughly 75%. Why? Because broken support often drags prices down. Retracing to the scene of the crime is textbook. It's still a bounce, not a breakout. What to do now? Monitor BTC at 118K. A confirmed break could mean higher highs. If not, expect a pullback or tight range. Trade smart. Lastly, Jack Mallers reveals a shocking truth. The post $1,971 era is over. The US Treasury Secretary just admitted it.
I wanted to pull up this tweet. This is probably the craziest self-admission from the Treasury Secretary in the history of the United States government by far. And the admission is really this idea that the post-1971 dollar is dead. This fiat currency era is over. We are moving back towards a world reserve currency land. And you hear it from the man himself, the de facto CFO of the United States. We are in a new monetary system. Now, change takes time, but it's over. And we are hearing self-admission from the US government and from the Federal Reserve. Guys, the way the financial system used to work and the dollar system was designed is when you're the world reserve currency, you operate in something that's called the Triffin's dilemma, okay? You can print the currency that everyone else has to use to store value, to settle trade, to price goods and services. But the problem is that you as a nation state have to run in what's called a deficit. And the US has ran what's called twin deficits. It means our greatest export is the currency itself. So we end up net exporting the currency on an annual basis. And what that leaves us is with a deficit. What that does to us is we accrue lots and lots of debt. And so if you're the world reserve currency issuer, you actually over time struggle to produce things locally in your country. Your currency is artificially strong. Because it's the world reserve currency, it's stronger than other currencies, which means labor locally is more expensive, which means production locally is more expensive. So this is known monetary theory. If you are the world reserve currency for a sustained period of time, other parts of the world, your global trading partners, will actually have a better market for labor, a better market for production of goods and services. And you, as the world reserve currency issuer, your main job is to strictly export the currency itself. So we're constantly providing the world with dollar liquidity. We're piling on debt, because we print. And all of the things that we consume in our lives as Americans are actually produced and created outside of the country. Now, what Scott Bessent, Donald Trump, pretty much everyone, this is a bipartisan thing, is that they're talking about bringing production back to America. We need to start making our own stuff. And the greatest example is in the Department of Defense, is that the US cannot go on any long sustained war with a near peer or a peer like China without the support of China, because we rely on their rare earth minerals to actually go to war and build weapons. And so it is now a national security threat that we have allowed this Triffin's dilemma to eat out the culture, the middle class, and the inner heart of the United States. The benefits of this system are now not outweighing the cons. The benefits have ran its course, and it's drastically harming the United States of America. So when you hear that Trump wants factories, that's not a Republican thing. That's not a red thing. That's not a right thing. That's America needs to get back to producing its own stuff that it consumes. It is solely reliant on all of its trading partners to sustain a lifestyle and protect itself as a country. Okay. Now, based on everything I just said, in order to produce your own stuff, the currency itself has to get weaker. The United States has hyper-financialized, meaning what the US is predicated on is that the stock market does well and the companies grow margins and grow earnings and grow profits. And the best way for companies to do that is to build their company cheaply, right? And so, of course, if you're Apple, why would I have twice the expense to build the iPhone by building it in New York City when I can build it and subsidize it in China? So if the United States of America and the US government wants iPhones to be manufactured in America, wants NVIDIA chips to be built in America, wants the food, wants the technology, wants the hardware all to be able to be produced here in America, wants the rare earth minerals to be produced here in America, the currency has to weaken to be competitive in the export market. And this is a complete fundamental change in how monetary order across the global landscape works. Everything is changing. And guys, if global trade partners are not recycling their profits into dollar-denominated assets, into US debt, and instead they're being ordered by the United States to fund our factories and to fund basically a world where the US currency is weaker, everything changes. Everything changes. The US wants to be the Bitcoin superpower of the world. The US is focused on accumulating Bitcoin. I continue to believe it's because you have to debase the dollar against something. That something is gold, that something is Bitcoin. Bitcoin is something that the American people can have access to through capital markets and businesses like 21. Implementing the Genius Act is essential to securing American leadership in digital assets. Stablecoins will expand dollar access for billions across the globe and lead to a surge in demand for US treasuries, which back stablecoins. It's a win-win-win for everyone involved: stablecoin users, stablecoin issuers, and the US Treasury Department. This, not that I needed to prove the idea, but this is as good as proof gets. The United States' interest in stablecoins is to finance our deficits. It's to support the treasury market. The treasury market will be supported by its commercial banking system. It means all your bank deposits will be lent to the US government. Do not own dollars. Buy Bitcoin. It means it will be supported by leveraged hedge funds out of the Cayman Islands, okay? And it means it will be supported by stablecoins. Now, the interesting thing is stablecoins grow as Bitcoin grows. The best use case for stablecoins is they are the de facto reserve trading pair against Bitcoin. So if Bitcoin goes on to be a $10 trillion asset, stablecoins are going to have to 5x from here too. So the United States very well understands the best way to support stablecoins is to support this industry. They're going to be very supportive of this industry across all legislation and regulation, and they're going to be specifically supportive of Bitcoin. That, I think, is going to continue to be a story and continue to be a fact
Jack Mallers says the post-$1,971 system is breaking, and few are ready for what comes next. Here's what he means. Since the US left the gold standard, the dollar's power came from exporting currency while importing goods. America printed money and outsourced production. Over time, that hollowed out US manufacturing and made the country dependent on foreign supply chains, including for critical defense materials like rare earth metals. Now, Mallers says the Treasury isn't hiding from this anymore. In a recent speech, they acknowledged the need to de-risk supply chains and rebuild industrial strength at home. But that means something big. The US may need a weaker dollar to support reshoring. And that's where Bitcoin comes in. Mallers believes BTC isn't just a speculative asset, it's part of a digital hedge strategy, alongside gold, alongside stablecoins. He points to growing signs that US policy is warming to digital assets, not fighting them. If that trend holds, Bitcoin could become central to America's new financial framework. It's not just a tech play, it's geopolitical, and it's time to pay close attention. This isn't just about prices or charts, it's about a fundamental change in how the world's money works. As the dollar weakens and Bitcoin gains ground, new opportunities and risks are emerging every day. The story of money is being rewritten, and those who understand it first will benefit the most. Stay sharp and stay informed because the next financial revolution has already begun. If you want the edge on what's coming next, hit that subscribe button and join the crew. Trust me, you don't want to get left behind.